Last one, Austin, is a unique entity, and I'll quickly explain what that entity is at the beginning of the analysis. But what is a company?
So in essence, the first 6 that we picked were stocks. The 7th one is a REIT, and it is OHI. Is that the stock ticker, Fabio?
That is the stock ticker. So in this case, we're going to check this as a yes. So we're going to do different types of calculations in the background. And
yes, yeah. So Fabio, we kind of created a valuation for this earlier tonight, and let's kind of break that down as well as our thought process after we get through a little bit of the preliminary business overview of the specific company itself.
So yeah, we'll talk about that right after. And basically, for anyone who doesn't know what a REIT is, it's a real estate investment trust, and it was designed to allow retail investors to invest in large commercial real estate properties without having too much capital, obviously, to front the capital to build these properties or buy them. So in this case, OHI is let's go ahead and put in the ticker now that we're here. OHI is a healthcare REIT that primarily invests in nursing homes and assisted living facilities. And something that one can think of is, well, what's there going to be a lot of going forward?
People entering nursing homes, Fabio.
Or
a lot of people entering.
That's a nice way to say it. Old people. It's gonna be a lot of old people.
Yes.
The baby boomers. There was a lot of them, and they're gonna need certain arrangements to be made. And OHI owns the assets that should benefit should that thesis play out. Keyword: the thesis has to play out. So that thesis being that they go to these assisted living facilities. Now, do you think right now there is a problem with Omega Healthcare Investors or its industry?
Well, kind of on where you're going with this and just kind of the inflection in your voice, Fabio, I would probably say yes, there would be a problem.
Yes. So recently a subsidy just ended for a lot of their operators. And so that can carry negative effects to the operations of OHI because it could trickle down to the rents. So with OHI, we do our standard 15. Looking good already. I don't even have it at growth rates. So yeah, looking good. It is a REIT, so we have to assume some share dilution. Unfortunately, it's par of the course. And we're going to assume, I like to be just conservative. So let's do the whole enchilada. And now we see, okay, what are some growth rates? I'm going to go from, I know that they're projected to grow. All analysts have them growing their rents. So remember, they grow in 2 ways. They increase rents on current tenants, and they acquire new properties at hopefully favorable prices. And they are one of the biggest in their sphere. So they are able to get good deals and good capital. Typically, they are not A-rated though. There's not many REITs that are A-rated, fun fact. So unfortunately, we can't. Oh.
Huh.
3%. Yeah, because that was 300 per year.
Yeah.
And then 4. And then let's even do 5. Well, let's do a higher one. Okay, so boom, boom, boom. Not good, not good, not good, not good. So 15%. Now, I'm missing something, Austin. With REITs, this model is going to be a little more conservative because it is not counting dividends. We don't want to count dividends. We want to count the potentiality of the dividends. So if you get the dividends, you actually nullify this. So we do a simple math trick. We say you get this dividend and you reinvest the whole thing. You don't take any of it. Okay, keyword, you cannot take any of the dividend. You must reinvest the dividend. And then it essentially acts as though you are buying your shares. So you counteract the dilution. And if the dilution is about negative 4.71%, with some quick math that let's round that to, let's make it worse. Let's make it 5%. share dilution, and the dividend right now, let's collect that data. Is 8.8. So let's round it down. Let's always be conservative. Round it down to 8%, 5%, so that we have a positive 3% buyback effect. Right? Boom. So you see, everyone following with me on that. So again, the assumption is you don't take the dividend out and go, spend it on whatever. The assumption is you take that dividend and you plow it right back into the stock. You have to do that. If you don't do that, you can't assume that. And again, you got to play with the numbers. What happens if they cut the dividend? Well, then your numbers are wrong. This thing's only as good as the numbers you put in. So let's say they cut the dividend and we get 1%. I like to be a little conservative. I don't want to assume too much. We're not being too conservative, but we're being a little conservative. All right, so right here, it's looking okay. Again, that share dilution was pretty bad. So if you're going and spending out that dividend, your returns are going to be lower because you got to account for that dividend.
So Fabio, during our due diligence video, can we kind of go into some of the tax implications potentially with investing in REITs as well? Is that something that we can kind of explore?
I can say that now.
Okay,
yeah, it's fairly simple. Do not own a REIT outside of a tax advantage account. Just don't do it. It's so much better inside.
Fabio would not own a REIT outside of a tax advantaged account. That's what he's saying here.
Let me put it this way. The most tax advantageous way to hold a REIT by common knowledge is to hold it in a tax advantage account, because the income generated off a REIT is counted as ordinary income. The dividends are. While dividends from regular C corps are going to be counted as long-term capital gains and will tax as such. So it's more favorable taxation. The reason why is because REITs do not pay taxes on the corporate level. Remember that corporations pay taxes and then you pay taxes. So then you end up being about the same. So people who say that at the end tax rate is not that much. No, it is. It's about 21. And then if you are on the highest end, you're paying 20. So about 41% total. And then on the REIT end side, it's all counted as income. It goes to the top tax bracket. So whatever that is at the present moment, whenever anyone's watching this video. So if you put in a Roth IRA, you'll never pay taxes on it. And there'll never be a tax on the entity or on you. So you're good to go. Again, but for those details, consult your tax professional for if you have any questions pertaining to your personal situation.
Yeah. When Fabio says you, he's talking to me. So
yeah, I'm talking to the audience and Austin over here, because Austin's a little dangerous here with his REITs.
Oh yeah.
He's gonna go crazy with REITs. All right. So right here, I'm gonna point out some things. PE, it's garbage. Why is it garbage? It's the REIT. Ignore that. Don't even pay attention to that. Price to free cash flow, better, better. Dividend payout based on free cash flow, pretty good. I want to see that. For REIT, you should expect one that's high. So it's pretty good. Return on invested capital, decent. Return on assets, terrible. Return on equity, okay. Nothing exciting. Altman Z-score, it's going to go bankrupt. Not true. That is not a good measure for REITs. Okay.
Investing is a multi-layered cake in this instance.
It's always a multi-layered cake. Everything is about nuance. People who just do a blanket analysis, they're gonna find out the hard way. All right. So current and cash ratio. We're gonna explore that in the due diligence. That's just something in the model because it's a REIT. The solvency ratios looking pretty good. Nothing crazy. Anything on the profitability ratios that stands out? Again, ignore gross profit margin. I'll explain why after.
82% operating profit margin. I would assume that's what you're about to explain. And then a 23% net profit margin. Just kind of looking at that immediately.
All right. So those metrics kind of not applicable too much to a REIT, but kind of. Then operating margins are, but the net profit margins are not. That is because, for those who are not accountants, Austin, when when a company owns real estate, what do they do to that real estate that lowers their net income? GAAP net income.
They depreciate that real estate.
Mhm.
So in essence, they are taking non-cash expenses that are still expenses on their income statement, and that lowers their income.
Very good.
So,
yes, exactly. That was perfectly explained. And I hope everyone in the audience kind of gets that. If you're confused on that, just comment below and Austin will get back to you.
yes, this is my bread and butter, Fabio. I could do this all night. I'll be here all night.
So the what happens if the business keeps acquiring new real estate? Do they have more and more and more that they could depreciate?
Yes. Yes, they do.
Yep. And so that's why we don't really use net profit margins. So some of the things we're going to look at as well, real quick, and we'll go to our data input tab. Make sure we go to this section, and I'll zoom in over here because nothing else really matters. So this is for the REITs only. So for the REITs, just make sure everyone's focused on this. For the REITs only, we want to look at the debt, the book value, and the real estate. And these two measures are what really matter for a REIT, AFFO and FFO. Really, it's up to you which one you use. There's no one really has a concrete answer as to which one's better or superior. It depends on what things you find more important than the other. FFO tends to be a little more conservative. Adjusted funds from operation. By the way, that's what it stands for. Funds from operation and adjusted funds from operation. Some people believe the AFFO is the right way to go. Some people believe FFO is the right way to go. You know, that's up to you. Real estate value, we're taking that, and what are we doing? We're removing what, Austin?
We are in essence adding back the accumulated depreciation to the real estate.
Now, why is that? Why would we be doing that?
Because what accumulated depreciation represents is the excess amount quarter over quarter, year over year of the depreciation that's being taken on the fixed assets of the depreciation that's being taken on the income statement.
All right, calm down with the accounting. Yeah. Calm down with the accounting here.
I know.
All
okay,
right.
Okay, hold on.
As a business.
Simple. Yes. So when you take depreciation lowers your net income. And then what happens is it's accumulated on the balance sheet as a contra asset account to your fixed assets, to your property, plant, and equipment. So what we're doing here with this real estate account here is we are adding back that accumulated depreciation onto the fixed asset balance itself, which is giving us exactly the numbers that you're seeing here. Was that better, Fabio? Did I explain that
a little
better?
bit? You're missing one key detail, which is why. Yes. So this is the accounting separation. An accountant looks at it that way. Yeah. But when you're a business owner, what do you care about with the real estate?
You care about the value of the real estate.
Yep. So the value of the real estate, which is that necessarily the depreciation value, the book value?
No.
Nope.
It would be the fair market value, correct?
Yep.
Exactly. See, Fabio, I can not only be an accountant, even though you always say, so I could be a business owner too.
So with the real estate value, that's kind of why we did that. We added it back because that depreciation doesn't mean the real estate lost value. It does mean that for the purposes of taxes or, GAAP accounting. But that's the accountants, they're saying that thing's worth less, but is it really? Not really. If you buy a house, you could depreciate that house, but is it less valuable over time? Or did you just sell it for a lot more, right? The point of depreciation is to show it's to represent the wear and tear, right, Austin?
Mm-hmm.
Yeah, that's the purpose of it. So
to add on to the tax treatment, you would have to add back the unrecaptured Section 1250 gain to it. But that's for a different, that's a different topic. Yeah,
we're going to get into a tax lesson here.
Yeah. Don't worry, Fabio, the accountant's not coming back. The business owner's here to stay. So
for the sake of our audience.
Yeah.
So then the book value, we care about that for a REIT, and we have our custom measure on that. But the most important one is the real estate value per share of EPS. And that is so you're paying about double, so a 2x multiple on that real estate value per share. That excludes, so that's taking out all the debt on that real estate. And then, of course, taking on a per share basis. And the debt, what is the debt represented on the real estate? It's tied to the real estate, right? So is debt going to be part of the game here, Austin?
Yes.
Yeah,
Yes.
it's part of the course. You got to
Yes.
take on debt to buy that real estate, or they issue shares. I would prefer them to do which one? What do you think? The most?
You
Tend to.
would prefer them, knowing you, Fabio, you would probably prefer them to issue debt.
More, yeah. Leaning on that. It depends on the
Yes.
cost of capital, but yeah. So
Yes.
if the interest rate's too high and the stock price is actually really high and the dividend is really low, I then change my mind, because what you want to do is get the delta. So the delta means, like the one number minus the other. So the difference, you want the delta between the cap rate of the asset that they're acquiring. Cap rate is simply the percentage rent as form of, like, basically you say the rent is 100,000 and the property is $1 million, the cap rate is 10%. So you want the delta of the cap rate and the dividend to be a positive number. So you want that dividend rate to be lower than the cap rate. And then you want the growth rate of that dividend to then be sustainable. And so you measure debt and you measure the dividend yield. So whichever one has the greater delta, the management team, if they're good, they're going to take the greater of the two. And if they don't, they're bad capital allocators. So it just depends. Here in this case, wow, this dividend is pretty high. So I don't want them to issue shares right now, because it's probably going to be hard to find cap rates that are greater than 8.83%. I don't know what their debt rates are. That's what we're going to find out, hopefully, in the due diligence portion.
Well, that is what we're going to find out in the due diligence portion, because if you guys think that this has been due diligence, this is only the preliminary analysis. We're going to be coming out with a comprehensive, in-depth due diligence video of this particular REIT that we just looked at today. So Fabio, to kind of wrap this up right now, what are some of your closing thoughts that you might want to give to our audience now, that if you guys have stuck with us for this long, you guys are the best. Thank you so much for watching and supporting this channel, by the way.
So closing thoughts, all the businesses we kind of took a look at, I'm kind of interested in some more than others, but overall, I enjoy looking at new businesses every day. Some of these I've looked into in the past. Obviously, one of them is a decently sized position, and I'm re-exploring the position basically with you. And we're doing it with an audience this time. So we're going to see whether or not I should trim the position, add more to the position, or just sell the position, or leave it as is. I could, because I'm at a different price point. My risk is much lower. So with that, I think I'm looking forward to doing the due diligence on all these companies. What do you think?
Yeah, I would probably say that I'm really excited to kind of do the due diligence into these companies too. And what's really exciting me is potentially what I might find when I kind of go through these SEC documents. Because, Fabio, that's kind of how we like to do it. Like, you're the one who looks at it and you're like, oh, this looks incredible, blah, 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 blah. And then I'm the one that's like, there might be something wrong here and here. And then most of the time, in fairness, Fabio, you're like, nah, that's not an issue. That one time you're like, oh boy, we need to check more into this. So that's kind of what I'm really excited for, being honest with you. I'm really excited that there's a potential of there being a story that we can really find during our due diligence of these said companies. So with that being said, thank you all so much for sticking with us and really watching everything that's been offered here today. And if you've liked what you've seen, please be sure to like, comment, and subscribe. Because we're small, we do respond to any and all comments. We respond to as many as we can in all of them. And also, please feel free to visit our website at capitalmindset.org. We're your hosts, Austin and Fabio, and we look forward to seeing you guys again. Take care.